Hello, welcome to Accounting Hub. I'm Professor George Scarping, PhD in Accounting, and our topic today is Promissory Notes. So this is one more video of the Accounting Hub by Dr. Scarping. More than 200 video here, guys. Enjoy it and subscribe to our channel. There are a lot of nice video and new videos coming, so you will be the first one to know. So Promissory Notes, what is it? A written and signed promise to pay a sum of money at a specific time is called a promissory note. A person or business to whom a liability is owed is called a creditor. A promissory note signed by a business and given to a creditor is entered in the business books as a note payable. So, if I sign the notes and then I promise that I will pay you, I will record it as a note payable. On the other hand, a promissory note that a business accepts from a customer is entered in the business books as a note receivable. So, okay, I am signing the note and I promise that to another company that I will pay them $1,000 or whatever. On my booking, it will be notes payable. On their booking, it will be notes receivable. And notes payable and notes receivable are frequently referred to simply as notes. And the person or business that signs a note, thus promise to make payment, is called the maker of a note. And usually we have interest. So, okay, I will pay you this note, $1,000 plus 8% interest or whatever. The person or business to whom the amount of a note is payable is called the payee. The original amount of a note, sometimes referred to as the face amount, is called the principal. And the interest, the percentage of the principal that is due for the use of the funds secured by a note, is called the interest rate. The date on which the principal of a note is due to be repaid is called the maturity date. The length of time from the signing date to the maturity date, usually expressed as the number of days, may be referred to as the time of a note or term. So, let's go here. This is a promissory note. So number assigned to the note, the date, the time of the note, how many days. Usually a promissory note is based on days. The payee, the principal, $2,580.35. The interest rate, and the maturity date. So 8% per year. Our percentage in the U.S. on accounting is based on finance, is year based. So it is per year. And maker of the note, witness, and that's it. And the interest on promissory note, an amount paid for the use of money for a period of time, is called interest. How do we find it? In the U.S., there are some countries that this is a little bit different, but here in the U.S., principal times rate. So for instance here, principal, number of days, and the interest rate. So how do we find the interest? Principal times interest rate times time as a fraction of a year. And here we consider our month 30 days per month. So 90 days divided by 360, or we can consider it per month. 3 months divided by 12 months. So interest for a fraction of a year, it is $51.57. And the amount that is due on the maturity date of a note is called the maturity date. Maturity value. So principal plus interest, maturity value. If we are working on days, term of the note, 90 days. How many days? March, many days in April, days in May, days in June. Then we have our rates, our interest per month. So here, number of days of the first month, days remaining after this month, lesser of the days of the month and the days remaining after the previous month, days remaining for the last month. How do we record this collection? When a note receivable reaches its maturity date, the maker of the note is expected to pay the maturity value to the payee. The interest earned on money loaned is called interest income or interest revenue, but most common name is interest income. The interest earned on a note receivable is credited to a revenue account titled interest income. Let's go to our Excel file. Guys, remember, all our Excel files are free, and the link to download it is in our video description. Okay? So let's do it here. March 18th. Accepted a 90 days, 8% note from Skinner Card for an extension of times on its... It is missing here, so just a second, guys. Whoa. And now we're good. Magic. So March 18th, accept a 90 days, 8% note from Skinner College for an extension of time on its account. $2,578.35. Note receivable number 6. So what is our journal entry? So an extension of time on its account. So we are moving from accounts receivable to notes receivable. So we debit, so let's do it here. So we debit note receivable number 6. How much? 2,578. We credit accounts receivable, the same number. And here, guys, today, March 18th, it doesn't matter the interest because it will matter only when we receive them or at the end of our fiscal year. So here, perfect. Skinner College. So we have no accounts receivable balance for this company anymore. So we transfer to notes receivable. So we credit it because we are crediting accounts receivable. So no more balance. As well as accounts receivable. Here, let's consider this beginning balance. We are moving from accounts receivable to notes receivable. So we are moving this credit accounts receivable to a debit notes receivable. So let's consider these note receivables. Beginning balance of $3,000. We are adding this $2,000 here. So we are debiting it. And then nothing on cash receipts yet. However, June 16th, we receive it. So the company paid us. Received the cash from the maturity value of note receivable number 6, a 90 days, 8% note, principal $2,578 plus interest $51.57. So the math for this one, it is here, 51 and 57. Okay. So let's do it. Whoa. So guys, almost a live class, huh? Okay. So let's do it together. June 16th, We received cash, so our debit will be cash, receipt 782. How much? The total, 2,629, or principal plus interest. What we will credit? We will credit notes receivable. However, what do we have on notes receivable? It is the principal only. So it's not matching. Why it is not matching? Because we need the interest income. And the interest income will be the 51 remaining. Let me delete this one for now. And now we are good. So, Skinner College, there is nothing because this is the accounts receivable. Accounts receivable, nothing. Skinner College, we have it now. So, we credit it because we are receiving it. So, we have no notes receivable anymore. Notes receivable here. Better. So, notes receivable. Only the $3,000 that is the beginning balance. Now we have cash. And let's assume here a lot of transactions. And this is our transaction. So, notes receivable. Document number, we have it here. R782. Debit, credit. We are crediting notes receivable. And it is not accounts receivable credit. Pay attention here, guys. Most common mistake here. Notes payable is notes payable. Accounts payable, accounts payable. They are not the same. So a credit, notes receivable. And what is the cash debit? The cash debit, 2,629. So we are not balanced. What is missing? We also receive the interest income. How much? On credit, interest income, 51. So we have these numbers balanced. Okay, guys? Perfect. What if we have no payments? That's what we call dishonored note. So a note that is not paid when due is called a dishonored note. How do we record it? Let's consider here, June 23rd, Stout Company dishonored note receivable number 4, a 120-day 8% note maturity value due today, principal 3,000, interest 80, total 3,080. How do we find this 80? 3,000 times the interest rate, 8%, times 120 days, divided by 360 days, the 80. So, I will copy and paste the formula here, and instead of the 3,000, the cell here, 3,000. So, let's do it again. 3,000 times 8% times 120 divided by 360. $80. So, if they dishonor it, we will move back this number from notes receivable to accounts receivable. We have no note anymore. So, June 23rd, 2022, accounts receivable, and here memorandum 98. How much? The principal is $3,000. However, they promised, this stout company, they promised to pay me the interest. So my debit now will be both. I am legally able to charge this company the interest as well. And I will credit notes receivable. I have no notes receivable anymore because I have the accounts receivable. How much? $3,000. It is not balanced because we need the interest. So interest, income, the 80. Let's update everything here. So we need to update the accounts receivable. So the accounts receivable here is stout company, the 3,000. So we have this ending balance, $17.9 thousand. We are debiting accounts receivable, 3,080. So 20,987. The notes receivable, stout company, we are crediting the $3,000. So we have no balance anymore. Cash, nothing on cash. They didn't pay us, so no cash. But we need to transfer. So we need to reopen the stout company journal. So transfer from notes receivable. So we debit here. Now the new accounts receivable is 3,080. Cool, huh? I love this topic. Very, very interesting. However, not that easy. So if you have questions or comments, just leave it here or email me at jscarping@gmail.com. Thank you so much for watching this video. Have a very nice day and God bless you.